So here we are, as of 2015, London house prices, average of over £500,000, 514,000. And this explains perfectly the London real estate bubble. And with any highly central location, be it Vancouver, be it Sydney, be it London, be it New York, the prices inside of these capitals have been among the highest rise in prices in the shortest amount of time. So from 2000 to 2015, and in fact it goes a little bit before because it says 17.25 as of 1995, it's had a 4-time gain. But what this chart, as it's self-evident, shows is however long the period of the rise to that euphoria stage is matched in its revision back to mean, back to its start point. So by 2035, the prices in London should be the same prices they were in 2000. Now this might happen in a general market in those time frames on a traditional chart. But when we're talking, and this is what is so hard to actually gauge the information and gain the information, let alone a systemic financial banking meltdown, an explosion of trillions of debt will send this down in no time at all. It won't take 17 years. It will take 2 years. But the point I'm making is, it's a cycle. And these have been plotted and seen time and time again. And ironically enough, the source is the UK Land Registry. So changing style a little bit here, we're going for a bit of background, deep research. And those of you who are aware with the Martin Armstrong work, he does extremely deep data collection going back centuries. And something that he shows us here, from the period of 443 BC to 2032 AD, we have cycles. And he classifies this as the economic confidence model, which is calculated at a 309.6 year wave. So every 309 years, a civilization grows and collapses, grows and collapses, grows and collapses. And once or twice you might think, interesting. But when it's repeated time and time again, it makes you think, maybe this guy's got something. And that follows on to this next chart, which each 300-year stretch breaks down into market cycles of 86 years. And this is called the sovereign debt cycle frequency. And he's given us 2 full set examples of this period, from 1845 to 1931. And between these crocodile teeth gains and losses, they represent an 8.6 year transition. And all this, guys, was portrayed and the research logged in 1979 by Martin Armstrong. So you can just actually count along. It's every 6 cycles is a big boom and then a big bust. And as I stated earlier, the big busts always go lower than the previous, higher highs and lower lows during each market cycle, each civilization cycle. So as his arrows pointing to 1923 up until 1931, followed by a massive crash, the 8.6 years then spanned to where we were in the 2008 crisis, which is obviously round about this area here. But something about the 2008 crisis is I don't think it was actually intentionally planned. Because why would you make people aware of the increasing situation that was occurring? Because a lot of people became aware and woken up to the Ponzi scheme that it was. So they miscalculated something inside of the derivative chain, which snapped. And they did everything possible to fix it and reassure the people that everything's fine. Which is where we are now in this final section up until 2017, which was a drawing and diagram issued in 1979. And don't you find it ironic that we are at the peaks of housing markets, of Dow markets, now above 20,000, just up at this pivotal point. And the low is going to be way past the previous lows, because that's the market cycle. Go to the next image. And this is another image as of 2015, comparing the UK house price versus the Martin Armstrong real estate cycle. Now, as of this period, the housing market was at 200,000. We have now gone to 220,000. And his housing cycle was predicted in 2015. We can clearly see his 2007 crisis for the real estate market and for the housing market was spot on, which crashed and regained with confidence in 2012 to now 2015, although it's obviously 2017. So the quantitative easing and the banking industry has eked out another couple of years in comparison to this diagram. And they have thrown everything possible at the systems to keep them propped up, and we know that. But look what is the overall finish position of the housing market, the real estate business cycle. By 2033, it will be back to its mean average all the way back from 1955. So that is predicting we can expect to see 1955 prices, whether it be in equivalent terms to today, i.e. whatever it was, £5,000 a house, or whether it will be the house is still £250,000, but we all get paid £50,000 a week. So that would be a hyperinflated currency, totaling all the way up into the quadrillions in circulation. That's something we won't know. But I can understand the principle of if people lost massive amounts of ones and zeros off of their computer screens, they would probably have the mindset of losing wealth. Whereas if they had the continuation of the belief that their homes are still worth what they are, well, nothing's changed in their naive understanding of markets. And as we know, that's 98% of society absolutely clueless about reality. And they still go by their windows in the high streets looking at those homes for sale in their vicinity and how they're gauging in comparison. But it goes without saying, this is very interesting images, and you can see how it ties into the current cycle, the current market, and it's, in my opinion, brilliant, because it gives us time to just catch this and make as many people aware and prepare. But obviously people won't believe it. So guys, we're going to go into silver now, but it takes a lot of fundamental understanding inside of the markets and the cycles to even start with getting to grips with what can happen in the silver market, because we only have historical trends for the immediate past. We don't have data going back centuries, or I wasn't able to find it in pound or dollar terms, but I'm sure there's stuff out there. So what we're starting to see on this chart here, which is from SRS Rocco, global silver market annual net balances. So during the period of 1975 through to the year 2000, silver was roughly in a positive netting market, meaning there was more above ground stocks being mined for consumption and sale than there was being used. However, things changed from the year 2000, and every single year from 2000 to 2015 there was a net deficit, and we're talking into the hundreds of millions of ounces, and all that has to come from previous stockpiles, i.e. from the previous 20-year period, and from whatever stocks are available from before that. Now the biggest question for all the silver guys out there is, when is this market going to dry up? When is there going to be no more available stock? We sometimes see from governmental agencies printing our favourite silver coins, They are temporarily stopping the coin productions for said month, or they are allocating the amount of coins available. Regardless of what is going on, we are in a deficit, and that deficit is going to continue until this market snaps. We will drive all the physical precious silver metal from wherever it is collecting dust and use it to protect our wealth and use it to transfer our wealth and take the bankers' artificially manipulated perception of wealth when it comes time to trade. Now, something that is also occurring inside of the mining sectors who are producing these silver bars for retail to the consumers who need it in electronics, to the medical companies, to the governmental stamping agencies. The price of silver is being controlled to prevent the producers capitalizing on their mines. They're basically throwing scraps of currency to the mining industries to produce the silver the nations need. Getting a dog to dig a hole for you and chucking him a chicken bone for his efforts. There's only a certain threshold where mines are willing to operate, and quite often they operate on losses because of the fluctuation that occurs inside of the precious metals markets via the algorithmic trading. Now obviously guys, you can pause this and take a look at the figures, I won't go into that. So we then ask ourselves, what is the exact correlation around gold and silver? Because we know the spread in ratio between gold and silver is the fundamental reason why we are buying silver. Because throughout periods of time, and like I keep saying, cycles, they have their periods where they are high and when they are tight in ratio. And what is particularly fascinating about this 30-year chart is showing as of January 2013, the highest level of spread between the two ratios signals optimal buying opportunity. And that actually has an algorithmic benefit inside of the traded funds because they will highlight this as a buy signal. And that in turn creates a drive and rise in the ratio to become closer. Because unfortunately these markets are controlled, as we all know, by the stock trading ETFs and COMEXs that are artificially controlling, suppressing and manipulating these markets. But that doesn't mean you can't understand it and position and hedge yourself in the most efficient way to capitalize in the housing sector. Or that's how I perceive it anyway. So currently the gold to silver ratio is 69-1. And that's exactly what I'm talking about here. When silver hit its peak at the end of 2011, the ratio dropped to about 32-1, and currently it's 69. And you can see the flows of the cycles, and we are in the same cycle. Its natural move is back down again. The market was artificially stopped here. We had the recession of 2007 and 8 hit, creating a flood for gold, which then created a spike which was delayed in silver. As we know, silver always outperforms gold in its rally. The banks, after they figured out, okay, we need to flood the markets with quantitative easing, we need to suppress this silver and gold rise and smash it back down. So that is what they have concentrated on during the last 5 years, is suppressing the price of gold and silver. They have installed circuit breakers inside of the COMEX trading to prevent the rise of gold and silver. When it hits certain thresholds, it triggers and prevents trading. This is a design to prevent the rise of gold and silver. So based upon that artificial suppression stop, which if we actually understand the market now, the likelihood of the people who are in control providing that it is against the will of those people, to prevent this rise, which we can only understand is the motive why the gold and silver circuit breakers were put in place, and the quantitative easing was flooded with the trillions printed to prop up the housing markets, the bond markets, the derivative markets, to the point where saturation has effectively occurred. To create new moves in the market now requires billions of fiat currencies to be created out of thin air. So with all that debt now in creation, and to prevent the same scenario occurring in the not too distant future, they would have to throw quadrillions at the market, at which point they will lose control of faith in the currencies. Hyperinflation will grip, and it will be evident to everybody that consumer goods are skyrocketing in price. People's wages can't even afford an apple, a bag of crisps. So we're currently at 69 to 1. The manipulation took place at 32. You can guarantee we will fly past that down to quite likely natural ratios of at least 10 to 1. And because it's going to be an unprecedented rise of wealth transfer, the odds are it's going to blow past that. And that's not wishful thinking. That's just reality of the situation. It is the end of that super cycle. And the only things that have been money for 5,000 years have been gold and silver. So that is where that transfer is going to take place. Of course, there's going to be other aspects like Bitcoin, but the predominant move and area you should be focusing in is stacking physical silver with the anticipation of converting it at the right time for property. So if we look at this chart here now, it's showing us the UK gold to house ratio since 1952. And this is the fundamental part of education people aren't told, people don't understand, and people don't care about. Yet we are shown gold, quite likely many times each day, but we've been disassociated from what gold actually means. And a lot of the information will be in gold, guys, because that's the easier information to find. There's not huge amounts on silver. But we just have to understand that the tracements of gold will occur similar in silver, plus some. And if we're looking at a 10 to 1 ratio, it's quite simple maths to just times these figures by 10. And I do honestly believe that that is a conservative estimate. But even if you want to be more conservative, you could just double those quotes and call it 20 to 1 at point of sale. You'll still be doing fantastically well. You'll just be moving that silver onto somebody who might have only just figured out and learned that's where I need to be. And they will double their investment in next to no time. So that's your wealth that you will be transferring if you swap too early. When's too early? None of us know. It's whatever's right for you at the time, because regardless, you'll be doing pretty darn well. So we can see the fluctuations that have taken place from 1952 in the region of 170 ounces for the average UK home, through to 30 years later being a similar price. Now when we got through to the 2000 period when everybody was going into stocks and shares and house prices were rallying hard, the prices peaked and you required getting close to 700 ounces to buy a home. So if you sold a home in 2000 and converted that cash into gold and held it for 8 years renting, you could have bought roughly 4 houses for that same investment. And that's only representing a 15% correction in the UK housing market. And that shows you the power of precious metal purchasings and of precious metal investments. Now what this image also shows you is in this section through here from 1980, where it had the big gold spike and the massive silver spike of all-time highs. And again, over here in 2011, the second all-time high. The medium average was 145 or 85 to 1 ratio to the house, which basically, in today's term, if we call an ounce £1,000, you could buy a house outright for £85,000. But bear in mind, that market was artificially stopped dead in its tracks and sent back the other way. So coming out of the largest cash injection with higher highs, again, we expect lower lows. So we're going below 85 ounces of gold to buy a house. Guaranteed. So this is one of the best images that I could find regarding the average UK house prices in ounces of silver. So 2010, obviously we had the spike in silver where it climbed down to 8,875 ounces to buy the average UK home. Again, artificially stopped and suppressed and then manipulated back up. But from the era in the 2000s, we can see it almost had a peak of 50,000 ounces. And we all know the price of silver during this time. It was like a few pounds. Extremely cheap. And that's obviously the optimal time to be buying, and you'll be doing pretty damn well now. And these are the sort of gains that you can make when the manipulation breaks. We will be having the same tracement going the other way. As to exact figures, that's the hardest thing to calculate because we're dealing with factors that have never been dealt with before. So we'll look at the London house price in gold ratio. So as of 2007, just before the crisis, 2006, 2007, you could have bought the average London home for 1,200 ounces of gold. But if you bought the gold instead of the house at the peak of its market and traded it at the top of its spike, you could have bought that same house roughly for 325. So again, you could have bought 4 houses in London for holding that piece of metal, which collects dust and is a relic, for less than 6 years. But we can see the manipulation take place during this phase here, which who knows, could continue all the way back up to here again. If the faith in the system and the manipulation and the flooding of trillions continues to occur and people don't care, that can continue to rise again. But the likelihood again is that this is a small retracement during this transitional phase where the sheeple have gained faith inside of the markets, the property prices are now returning, before the rug is pulled from, as the Armstrong diagram projects, the 2017 mega crash to basically reset all markets. And that will obviously take off back down to here in no time at all, obviously reflecting silver in similar fashion. And this is a perfect example, let me move this up here, and this is another perfect example of the gold flow, UK gold to house ratio. Something I'm going to show you in a minute, guys, is a technical chart reading terminology and diagram, which is being portrayed here. We have a traditional market forming, and then we have the higher highs and the lower lows. We have the same effect happening here with a higher high and a lower low. This is going to continue on a higher high and a higher low in a traditional cycle. But in the bigger picture of cycles, these charts shrink down and give you a different image. But we'll cover that more shortly. So again, here's just a quick confirmation in a silver ratio via London houses. In its peak of 2006, before the crash, you'd be looking at the region of 85,000 ounces. And if you sold in silver's high of 2011, it would have been 12,500. So with gold being roughly a 4 times gain, you can see how this is round about a 600 to 700% gain, because silver always rallies harder and faster and gains higher momentum than gold due to volatility and quite blatantly down to availability inside of this small niche market. And that's a key aspect to remember in the back of your mind when this event takes place, because you won't even be able to get this physical silver bullion, coin, money in your hands. So you'll basically be able to command how many of these you want to give for something. It won't be commanded by somebody else saying, well, I want 1,000. No, I'll give you 100. And that's the difference between somebody being able to get out of a dire situation that they're in. Unfortunately, this is how you make wealth. But that's why we're working so hard now and educating ourselves now to benefit when the time comes. And some of you may also think, well, why are you telling me this? Why are you sharing all this information? If this is true, this is highly valuable information. Yeah, it is, guys. What I get from actually helping other people is more than money, is more than wealth. To know that I'm actually going to help people of this planet protect themselves from what a group of evil people are trying to do is the very reason I do this. I think it's just an age-old battle of good versus evil. And there comes a time where we need to stop being so selfish and help each other. Don't get me wrong, I get so frustrated with ignorant people, with stupid, brainwashed people, which is why I don't mind sharing what I know with you guys. And we are among the 0.01% of intelligent people on this planet. And maybe one day you'll remember such videos like this that gave you those ideas, that showed you the right steps to be taken, and understand it's actually our duty to protect our fellow man, why so much evil is trying to destroy everything. And equally, the more people who are trading and discussing these maneuvers, the more people that will become aware on the transitional timeline when this all takes place of these trades. In other words, the more people that are going out into the world and trading with silver, directly trading for assets with physical silver, the more people will learn and get educated about, maybe I'll take that offer for silver. Whereas before, they'd rather take a Hershey bar over a 10-ounce bar of silver. So the more people that go out into the marketplace and transact using precious metals, eliminating the need for cash transactions, the more likelihood people adopt precious metals trading, and it becomes the true form of real money. The next time a bank comes up with a scheme of, hey, I can give you these paper notes for that silver coin, people will just say, fuck off. And that's the whole principle why I'm doing this. So back on track, back on topic. This diagram here from 1955 through to 2015, UK house price, silver average. Can you see for a 35-year period, a 40-year period through here, how flat the market remained, plus minus a couple of spikes, within the range of 5,000, 7,500 ounces per house. And then just look how crazy and manipulated that price was. So it goes without saying, guys, this is just a market. This will revert back to the minimum of 5,000. So if you're purchasing in the range of 15,000 ounces per house today, and you know in a not too distant future it's going to revert back to 5, you're getting 3 times the purchasing power of that coin, of every single coin that you buy. And if you didn't notice, that's a perfect head and shoulders for those technical analysis guys out there. So we're just going to switch over the subject a little bit here now, which is the 200-year Dow Jones gold ratio. So if you didn't see it, the massive red line is the 1930 introduction of the Fed. So before that period, when everything was on a gold standard, gold for a 100-year period was in the trading range of between 0 and 2 ounces to buy every single point on the Dow Jones. So then came obviously the Fed, the Federal Reserve, and we start to see massive swings occur. So you can use this information here to your own discretion. If you think the Dow is going to go to where the Webbot is predicting, 140,000, and gold is to remain flat, then obviously this rally here will spike up back up to here. So if you think gold is going to remain at $1,200 an ounce, $1,300 or wherever it is, and you think the Dow's going to 40,000, 50,000, then it makes sense to put your fiat currencies into the Dow and then to buy gold when you think the Dow's going to drop. And that's kind of what it's showing here. So if you had physical cash form in 1980. So if we say an ounce of gold during 1980 was $1,000, just for simple math, you could buy all the points on the Dow for 2 ounces, which means $2,000, £2,000, whatever currency. But if you invested in the Dow and there's a boom inside of the Dow market, then by the time that you sell up here during the manipulated prices of gold, you could have effectively sold it and bought 40 ounces of gold, let the Dow crash during a market reset, and sell those golds back into the Dow. So it's a market to watch. And again, you'll see shortly, this is a perfect diagram showing you the higher highs and the lower lows through here. So from up there down to there. And then again from here, 1950, wherever it is, up to its peak, up to its high, and then down to its lower low. And again, higher high. So what would you naturally anticipate is going to happen? Well, judging by what's going on there, it's going to be a lower low. So if we take the lower lows, they all float around the 2 ounces of gold to buy all the points of the Dow. And projecting that it's going to be a lower low, you'll be looking at, especially with a market crash, it's going to be no gold to buy the Dow because there's going to be no Dow. But just from the point of view, subject to if you think markets are going to increase or not, this is the information that you need to know, and it's education and it's understanding of different things you can do and different ways you can play things subject to your belief. But that's another way you can make hundreds of percent swaps between gold and fiat markets, but nonetheless extremely informative ways of playing the market. And this sort of information it's generational. You hand this down to your children because markets are multi-decade. So older families who have very high net worths play these moves. That's how they flow between the markets and become richer. That's why the rich are always getting richer and the poor are always getting poorer, because the poor guys just getting trashed trying to play the paper game. They're not even understanding. You want to play the paper game using the metals game. So moving on. Anyone for a cup of tea? So the reason I say that, we're now getting to time for the Silver Surfer. Cheesy, I know. So this diagram, or this technical trade, is classed as the cup and handle. Self-evident, really. The cup, the handle. It can also be classed as a bull and flag as well on a wider scale, but nonetheless, a rise, a consolidation over a long period of time, followed by a rise, followed by a short consolidation with a rally. And the rally will be as high as this initial stage through here normally. So let's take a look at where I'm going with this. So between 1969 all the way through to January 2017, this is an exceptional chart because it shows the silver spikes. And obviously gold is identical to this move, but there's more percentage gain inside of silver for all the reasons we know. So something I'll just point out here is the bull market in 1980. During the low patch of 1969, you could be acquiring physical silver, and this is going to be at spot price, so obviously plus premiums, etc. $1.64. By the end of 1980, which was an 11-year period, the price was $48.70, which equates to a 2,870% gain, followed by a bear market from 1980 to 2001. And obviously you can see these figures. But the next bull market was 2001 again to 2011, 10-year period, where you could have purchased for $4, and again it went to 58, 1,108% gain. So the rough average between those two prices is 1,500%. And bear in mind, this was the highest all-time price, especially when you take into term the level of debt inside of the system in comparison to the level of debt in this system here. So purchasing power during that period, if you sold during the spike, astronomical. But for those technical chart viewers out there, you'll know exactly where I'm going with this one. And for those of you who don't, check this out. So I'm setting the image of the cup, showing you what has happened in the last 30 odd years, 35 years inside of these two bull market sectors. And everything in between is just static noise, consolidation, and new bulls forming. Which is why we are at the most luckiest time, because we are at that tip of the handle as it's rising. And that is in a traditional market, guys. That's a traditional stock market move. It will grow way higher than its old high. So if we're looking at a 1500% move from here, well, I'm here to tell you it's gonna be way more than that. Because if the system snaps under the weight of everything, then I can't even predict the number, because there is no number it will go to. It's untradeable. It's literally whatever you set as a price in your mind is what people will either accept in trade for assets or they won't. And you will be in the driving seat, because there's going to be plenty of people willing to accept your offer. There will be hundreds of thousands of houses repossessed where banks will take direct trade for silver. We can't even comprehend what it is that we're going to transition into and what things are going to be worth. We just have all the numbers, we have all the data, we have all the statistics telling us where this is going to go. $1,000 an ounce, it could be 10 times that. It depends on if it's going to be currency backed, fiat currency backed, if gold's going to be back in the debt levels, the trillions and trillions of debt, which means the debt has to be divided by the amount of gold held by countries. And what does that do to silver? We obviously then have the Webbot saying there's going to be huge amounts of new technologies coming out requiring silver for high-tech requirements, that only silver is the only element that can be used for that facilitation. So it's really like this, guys. If you're looking at an average of a 1500% move and call it $10 an ounce, even though it's not, just for simple maths, numbers are irrelevant really. $15,000 per ounce of silver. So for 10 ounces of silver, sounds absolutely crazy even saying this, you could buy a $150,000 house. For 100 ounces, you could buy what is equivalent to a £1.5 million, $1.5 million house or pound house. It's all relative. It's all the same in each state, each country. It comes down to the people that will have and the people that will have not. But that's obviously all if the game ends, this whole fiat facilitating arena. And that is exactly why all the banks control the fiat currencies. That's why they control the precious metal markets. Because silver's the Achilles heel. You've heard that many times. It's that thing that makes it snap, because it's such a finite resource. And it takes hardly any currency to purchase the entire global stock. And we are on constant deficits. So there come a day where silver won't even be traded, because there isn't any silver to trade. So that's where it reverts back to gold, because there's tons of gold everywhere. And obviously pockets all over the place. Silver's not like that. Silver's a very finite resource, and it can only be mined closer to the surface. So there's less and less available stock of silver. It doesn't run into deep, miles deep veins like gold does. And that is the potential reasons why it can go 1-to-1, even higher. Maybe one day silver will reflect today's ratios of gold. It will take 80 ounces of gold to buy one of silver. What is silver used in? You've done the research, you've seen it. What is gold used in? Is that not a fundamental reason why it is a more valuable commodity? Why it is not real, tangible wealth? But the reasons the billionaires can't flood into it is because they're just catapult the price immediately. It's a secret underlying rule between the elite. Do not touch silver. Yet JP Morgan, well, they're sitting on hundreds of millions of physical ounces. Quite likely to capitalize, but to be the last ditch effort and sell it off, or perhaps just to keep it for its own personal elite agendas in its use in advanced technologies. Who knows? You know, your guess is as good as mine. But if there is one time that I would like to be living in, it's the beginning of this event. Take care, guys. I'll see you soon on my next video. Please do like this, share it, and if you found it informative, feel free to chuck me a bone via patreon.com, PayPal, or via the Bitcoin link in the description bar below.